Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, November 3rd, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Currently, futures are down, following up on a really weak finish on Wednesday after the Fed announcement. Dow Jones futures currently down almost 200 points. S&P 500 futures down about 31. NASDAQ futures down more than 115 points. Crude oil down about $1.30 this morning, back to about 88.70 or so. Closed at $90 a barrel yesterday, but we are back down a little bit today. And the U.S. 10-year Treasury yield up 12 basis points this morning, back to 4.19%. Very interesting move this morning because we really didn't see much movement yesterday in the yield. We were relatively flat for the day. It was a volatile day, but we were relatively flat. And given the hawkish tone of the Fed, I was a little surprised to see that the 10-year Treasury yield did not move up, but that is being taken care of this morning as the 10-year Treasury yield is up about 12 basis points. Got a lot of things to go over today. I'm going to start with the agenda. We will start off with that daily market recap, then talking technically, spend some time on the Fed action, earnings spotlight, and the 3 you must see. Before we get into any of that, though, let me take you over to earningsbeats.com. For those of you who are new, we have a big event coming up on Saturday, understanding market manipulation for more profitable trades. Yes, I believe there has been a ton of manipulation in 2022. I want to talk about that at the event. Also, if you're not familiar with how the market works, forget about 2022. I'm talking about every year. There are significant tendencies in the market. I'll just give you an example. One thing that I'll be talking about. There is roughly a 10 or 11 day period, consecutive day period within all calendar months, the same 10 or 11 days, which is roughly what, 1/3 of the month? It accounts for about 85% of the stock market gains, the S&P 500 gains since 1950. 10 or 11 consecutive days, the same days of every month, account for about 85% of the gains since 1950. Understanding that, pretty important. Knowing within the calendar quarter, you'll be shocked to see how the calendar quarters break down. When is the best time of the calendar quarter to be in? When do you not want to be in? These types of things are things I'll be going over. We're going to talk a little bit about options expiration, the impact that can have on the market. Anyway, it's going to be a great event. If you are a trader, even if you're an investor, I think you'll really get a lot of information and eye-opening facts about the stock market. But if you're a trader, you really need to have this information. Anyhow, this event will be held Saturday, 10 a.m. Eastern. It is free, but you do need to register. So if you go over to earningsbeats.com and then just scroll down, hit that register button, we'll make sure we get you set up for the event this week. All right, I'm going to move on. There's a lot to go over today. This was a crazy day on Wednesday. Let's start with the Dow Jones Industrial Average yesterday. First of all, the market reacted at 2 o'clock pretty strongly when the Fed first began its policy statement. Fed Chief Powell mentioned that the pace of increases was going to slow. And so initially, the market took this as starting off to be a very dovish statement. And literally, the market just exploded to the upside. But as I tell Earnings Beats members, and I'm sure I've talked about it here on the air before as well, what you initially see after the 2 p.m. announcement isn't usually, that initial move is usually not the last move. Normally, we get crazy volatility from 2 to 4. And there was no exception yesterday. We took off to the upside right after the announcement. And then Fed Chief Powell began talking about how, essentially, I'm going to paraphrase, but they're going to remain tough on inflation. They want to see a series, not one, not two, but the quote was a series of inflation reports that show inflation is in check. And they're going to remain adamant raising rates. And they've even, they talked about the fact that essentially this is going to go on longer than they anticipated, which in turn means that rates are going to get to a higher level than what they were previously forecasting. Now, do I agree with it? No. I think what they're trying to do is kill demand. They're trying to essentially kill the stock market. I don't think that's the right move because the issue is not on the demand side. It's on the supply side. But they're going to do what they want to do, and they've made their choice. The market's reacted, and it wasn't pretty. Dow Jones Industrial Average yesterday down 505 points. S&P 500 down 96. NASDAQ down 366 points. That was 3.36%, which was more than double the drop we saw on the Dow. Mid caps down almost 3%. Small caps down 3.4%. Small caps worst performers on the day. Looking at the moving averages, the Dow, because of its huge run up in October, still well above its 20-day moving average. So that doesn't look bad. We're getting a little profit taking. That's all that looks like there. S&P, though, one of the things I was looking for was I wanted to see it hold the 20-day moving average. It did not. It closed below the 20-day. NASDAQ wasn't even close to holding its 20-day, completely rolling over there. Mid caps and small caps still just above their 20-day. We'll see what happens. One of the most damaging things on the chart, though, that I saw was yesterday, the S&P 500's AD line moved down to about a 3-month low. We're not even down to the low price yet. So we are seeing deterioration. And one of the questions I've been asked, because I have been much more bullish since mid-June, one question I've been asked is, what might change your opinion? What might turn things for you in terms of believing that this is going to be a secular bear market? Well, I can tell you in the previous secular bear markets, 2000 to 2002, 2007 to 2009, the AD lines on the move down at about this point, several months in to the bear market, the AD line took a huge move to the downside, which makes sense because if you're going to keep going lower, you need significant distribution. And the AD line is what really tells us how much distribution is taking place during the trading day, the market's not being manipulated down by gaps, but true selling. AD line is a really good indicator for that. And you can see the S&P actually broke to its lowest level since back in July. So that's a negative. Now there's some positives, there's some negatives, there's a lot of mixed signals. I think you got to do what's comfortable for you. One thing I've been saying is to stick to ETFs for the most part. Individual stocks, if you're wrong, you can really get hit hard. I mean, you can get hit hard in ETFs that track the major indices as well, but you can get hit a lot harder in individual stocks. And if you look at what's happened to some of these consumer discretionary names, some of the technology names, communication services names, I'm thinking internet, software, the autos, some of these stocks have been hit really hard these last couple of days. Yeah, the ETFs tracking the major indices, not a whole lot better, but they are better. So that would be one thing I would be thinking about is if you are going to take chances on the long side, I would continue to stick with ETFs. Let the market right itself before you get too involved with individual stocks. From a sector perspective, utilities led, all 11 sectors were down. Utilities led by dropping only 1%. Financials down 1.25%. Financials really been doing well on a relative basis. Discretionary, technology, communication services, those three aggressive groups were your three laggards. Not a good sign at all by the way the market traded. All right, the 10-year Treasury yield. This does not show the open or the early morning action, but let me tell you right now that the 10-year Treasury yield is up 13 basis points to 4.19%. Still not up above the recent high, but it does look like now it's starting to curl back up off of that rising 20-day moving average. And you can see that's been the history really since the market topped back in mid-August. Once we broke out in the yield and the yield continued moving higher. And the thing is, when the yield's moving higher, history tells us that the S&P 500 typically goes up with it. And the reason that happens is that normally rates are going up because of anticipated increases in economic strength or the fact that we have economic strength. In this case, what's happening is the 10-year Treasury yield is rising because of inflation expectations. You're going to sell bonds that are yielding 2 or 3% as long as you're in an inflationary environment that's, we're seeing the annual core rate of consumer price index is what, 6.5, 660. I mean, makes no sense to own a 3% bond. Of course, you're going to sell it. And when you sell the bonds, yields go up. So, the hawkish statement yesterday was kind of interesting because if you look at the 5-day, 10-minute chart at 2 o'clock or late in the day, we really didn't see, well, this is November 1st. So we didn't get, actually, I saw a number of charts that were not updating here. Maybe it did rise more than I anticipated, but it is saying it's up 12 today. So I'm thinking it closed right around 405 yesterday. Anyway, wherever it closed, the 10-year Treasury yield did not move up like I would have anticipated, given the hawkish statement by the Fed. But let's move on. Talking about the Fed, let's talk about the Fed action here in just a couple of minutes. Let's first jump into talking technically. Let me show you a couple of charts here. First, the NASDAQ. You want to see volatility, what took place yesterday? Here was that initial move when the announcement first came out. So again, the market was literally sitting on right on the edge of its seat, waiting to hear what Fed Chief Powell had to say. Here we get the big move to the upside when the Fed appeared to be somewhat dovish. And then as soon as that rhetoric kicked in that, hey, essentially we want to kill the stock market, because that's really what they're talking about. They want the economy to weaken. And they want it to weaken rather significantly. They want to bring the demand down to the level of supply. Demand is not off the charts right now. Have you looked at any of the housing lately, any of the housing reports? Now, of course, housing went crazy and rates have been going up. I get all that. But housing has been, the reports have been very weak. Pending home sales, I think the last one was down 10%. So we're seeing a big slowdown in some areas. Sentiment has been horrible, consumer sentiment. So there are definitely areas that suggest that, we've got some issues in the economy. However, the Fed literally, I've been talking about it kind of like whack-a-mole. If there's anything popping up anywhere that looks like it could be hot economic data, the Fed is taking its interest rate gavel or whatever and pounding, whatever pops up. It's really been like a whack-a-mole kind of a game. Anyway, my take from yesterday's Fed meeting is that the Fed, I keep thinking they're going to change their tone, and they're just not. And if you look at the S&P 500, we'll look at that in just a second. Actually, let me go ahead and move over there. I want to show you, here was the Jackson Hole. You see this big red this big red filled candle right here? That was the Jackson Hole August 26th speech by Powell. You see this big red candle right here? That was the release of the August CPI. Do you see this big gap down before the huge recovery? This big gap down off of this downtrend was the September CPI report. Now we've got another big move to the downside. This is the Fed meeting. We've got next Thursday, the next CPI report. Just keep in mind that if the market continues to anything that favors higher interest rates, whether it's the Fed coming out talking hawkish, whether it's a CPI report, if that CPI report comes in hot next week, expect another big red-filled candle. Anything, we got a jobs report tomorrow. If that jobs report is stronger than expected, I think the market goes down. I mean, obviously, we get whipsawed sometimes, but I would certainly expect that any kind of a strong economic report is going to be met by selling in the stock market, because that is just telling us the Fed's not going to let off the gas in terms of raising rates. So we got to keep that in mind. All right, so now let's talk about that Fed action a little bit. I wrote an article yesterday about an hour and a half before the Fed announcement, and I indicated the three things that I was going to be watching, three things that were important to me. Like all of you, I'm trying to figure out what's going on here, and where I think the market's going to go. And we do get, if you study history, we do get some signals. One signal comes from the bond market, the 10-year Treasury yield. What does the Treasury yield think? What does the bond market think about the Fed announcement? Normally, you start talking inflation, you talk about higher interest rates, we're going to get a big reaction to the upside. Well, here, now this again was just the first day of November, so we're not getting the rest of the month. But according to the fact that we're up right now 12 basis points to 418, that would lead me to believe we finished yesterday at 406.01. Now this is showing 404, so we went up a little bit yesterday, a couple of basis points. I would have expected a lot more. So this yesterday afternoon was telling me maybe that move to the downside in the stock market wasn't going to last. Well, it lasted. Not only did it last, but this morning we've got the 10-year yield now up 11, 12 basis points. So check mark there goes to the bears. If we go back down to the S&P 500 support and resistance, this was the other thing I wanted to look at. Short term, I just wanted to take out 3,900. S&P 500. When we had this positive divergence, I talked about the likelihood that the S&P 500 would go through its 20-day moving average and had a really good chance to get to its 50-day, which at the time was up over 3,900. And I just said, hey, 3,900, we know that's a key resistance level. That's been where the market has pivoted multiple times over the last 5-6 months. I mean, you can see all these arrows. So we got to 3,900, and here comes the Fed announcement. I wanted to see a move through 3,900. Well, if we click on this chart, you will see that the high got up to 38.94. We got within 5 points of it, and then the selling kicked in. Now, that was actually that within the 38.94, I believe. I don't know if that was yesterday. No, the day before we were up over 3,900. So yes, November 2nd, we did get up to 38.94. So we got within 5 points of that 3,900 level. And then from there, we sold off 135 points on the S&P 500 in the last hour and a half. Failure at 3,900. And to the downside, I wanted to see the 20-day hold. We didn't. We closed beneath it. Futures are weak this morning. It looks like we're going to be significantly down again at the open. So we're rolling over right where the market has rolled over earlier this year. We've now lost the 20-day, and some of the rotation that I'm going to talk about was not good either. Let's go over and look at that. Market rotation. So this is the third thing. I've been talking about this a lot. And one of the reasons why I liked the market bottoming back in June was the fact that the S&P, when it went down earlier, we started to see key aggressive ratios start to turn back up, meaning that rotation was taking place. Money was moving back into aggressive areas. So the QQQ versus the spider was going up. XLY, XLP went up. And growth versus value on the large cap level went up, all while the S&P went down. So we saw the opposite of the rotation that we had seen at the end of the year, end of last year, when the S&P went up and all these ratios went down, telling us that everything was turning more defensive while prices were going up. That's a warning. Well, this is the same type of warning. Now, until October, I thought the rotation was still fine. We were still holding those prior lows. Everything looked pretty good. But if you notice, October was a pretty good month. And these ratios are turning back down, and they accelerated yesterday on that action. We actually have lost now. The IWF-IWD has lost that low from May. So we can't ignore this. Do I think that this means the market's going to collapse? No, but it certainly adds to the sustainability likelihood going forward. There are some mitigating things that we need to think about as well, and I'll get into some of those in just a bit. I want to keep moving because I still want to get through a lot. This is the NASDAQ 100. These are the components yesterday and what they did. Look at the sell-off here. And look at the group or groups that were selling off the most in the NASDAQ 100. 4 of the top 5 were software stocks. Higher interest rates kill these growth stocks like software, semiconductors, internet, autos. I mean, you can see Tesla down there getting hit pretty hard yesterday. These are all the types of stocks that will get hit because the future earnings get discounted back based on current interest rates. And as rates rise, the present value of those future earnings goes down. That's how valuations are performed. So not only are we in a situation where the Fed is trying to kill earnings of companies by, putting down that sledgehammer and trying to snuff out any strength in our economy because they ultimately want to snuff out inflation. So you've got the Fed trying to push down the economy, which in turn pushes down earnings of these growth companies. Forecasts are going to be lowered. And then you have the higher interest rates, which are going to lower the present value of those lowered future earnings. This is horrible for growth stocks. So if you want to know why those growth stocks have been hit these last couple of days, it's the threat, and not just the threat, but the fact that we have been seeing much, much higher interest rates. That's why when the market, when the QQQ underperforms the spider, if you look in 2022, it's generally been when the rates are going up because the NASDAQ has these stocks in them, have more heavily weighted and more of them. That's what's driving down the NASDAQ. All right. Yesterday, I have a chart list, relative strength industries. So I wanted to go through this and just show you that in the relative strength among all the various industries, these were the worst industries yesterday. Media agencies, aluminum, travel and tourism, tires, non-ferrous metals. These two surprised me. This is the mining. Gold mining, other miners. They were among the worst performers yesterday. I thought we were worried about inflation. So when I talk about there being mitigating reasons for things just not making sense, whereas just taking the stock market, based on what's happening on the surface, I think you have to be careful. Continue to be careful. I respect it. Listen, we're back down below the 20-day moving average. We've rolled over from key price resistance. I get it. I think being cautious now makes sense. But why are gold mining and mining shares among the worst performers on a day when the Fed keeps talking about how they're fearful of inflation? Gold, anything gold related should be doing really well in an inflationary environment when you're really worried about inflation. It's one of the best hedges. This just makes no sense to me. But if you go down, truckers, there you got a group that, delivers goods, not really seeing any strength there, a lot of relative weakness. This doesn't mean truckers are down 2.5%. This means truckers are down 2.5% more than the S&P 500. And you keep going down here, you'll see internet and their software. They were at, certainly underperformers. They weren't the worst of the group, though. I don't know, maybe take a little bit of solace from that. Here was the truckers. You can see the truckers moving back down below its 20, 50-day moving average. And this is in that transportation area. I think it's really important to, follow what's going on there and, keep track of the transportation. We want to see transportation doing well. And they're obviously truckers turning back to the downside a little bit. here were the earnings that came out before yesterday's open. So these would have been earnings that came out Tuesday evening or Wednesday morning. And these were the best performers. And if you look, 2 of them are financials, 2 of them are healthcare. Here's 2 of them are specialized consumer services. This is actually a group that's been performing pretty well. And then computer hardware hasn't been horrible. So the big winners were areas where the industry groups have been relatively strong. If we flip this and look at the ones that have been weak, or that the earnings got crushed, you'll see a little bit different story. Medical equipment has not been good at all. Media agencies not been good at all. Semiconductors have not been good at all. Commodity chemicals, no. Software, no. And you can see a lot of these scooter scores pretty weak, the worst performers. And that yesterday may have contributed to some of that weakness. But I want to go on. Well, one stock that did report looked really good was Super Microcomputer, making a big breakout on a day when most technology stocks were getting killed. Look at the volume coming in, the breakout there. So a good day there for SMCI. So the companies that are going to be reporting today, I want to go through this, and we'll just combine this along with the 3 you must see, because we only have about a minute and a half. I want to go over some of these companies. Now, these are the scooter scores before they get hit by the earnings. So these are the ones that, performed or haven't been performing well. So let's look at we're going to look in the pre-market. AUR. This one's up 6%, not bad. How about MRVI? Down 13%. How about RPD, Rapid 7? This is a software, down 18%. BHC, up 1%. TXG, down 1%. Wayfair, Roku, and Peloton. We'll wrap up with these last 3. Wayfair, down a little bit, not too bad. Roku, down 20%, down another $11. You think a stock can't go any lower, but when it's an underperformer, you want to be careful and you want to be on the sidelines. Huge move down there. How about Peloton? Not too many stocks have been performing worse than Peloton. Guess what? Right back down near the lows, down 15%. All of this little bit of a bounce gone with earnings. My point here is that when you're looking at these companies that are going to report, be mindful of which companies are showing relative weakness. And you can tell that based on their scooter score. Today's going to be an interesting day. I expect we're going to get some follow through at the open. We have had a lot of gaps recently where the NASDAQ is underperformed, and then the NASDAQ slowly works its way back up versus the S&P 500 during the day. I'm going to be watching to see if that takes place today. Are we going to go lower? Are we going to take out those June lows? That's a good question. Or not June lows. We already did that. Are we going to go lower? We're going to hit 3,000. We're going to go back to the pandemic lows. Those are great questions. I don't think so, but that's just my opinion. We'll continue to watch it every day. Everybody have a great day. I'll be back next Monday over at Earnings Beats for your next Trading Places Live. Please remember, Saturday, we have a big event. Go over to Earnings Beats, click on that Register Now button, and make sure you're set up. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.